Well, hello and welcome back to the 5 Pillars of Business Success for Startup, our boot camp edition. We're still on Pillar 3, Make a Profit. This is part 3 of Pillar 3. And if you recall, we started working on determining entrepreneurial profit in the last lesson. We got to Jimmy's lawn care, we got to his personal bills. If you remember, that means it's bring home money plus taxes. You did your P&T calculation last time. Hopefully you have now done it for your own business so you know how much money your business needs to bring home to pay your share of the household expenses or however much profit you want to generate plus taxes on that income. Remember, you got to pay taxes on whatever you're earning. So we know that his was $1,077 per week. Now remember, we switched that into a 4-week month for simplicity's sake, but he needs to bring home, well, his business needs to generate $4,308 every month to pay his bills plus his taxes. So we put that on there as part of our formula. Remember, we're working up the ladder to get to whatever his sales revenue needs to be, his price times the number of units sold, in order to generate an entrepreneurial profit, which means money left over to reinvest in the business. So now we're going to work on debt and other payments. What debt and other payments does Jimmy's Lawn Care have that need to be included in this calculation? Well, as you can see here, or as it is defined, what we're talking about is all monthly payments that are not counted as expenses from an accounting perspective. Just because they're not counted as an expense from an accounting perspective doesn't mean it's still not cash that your business is spending on those debt payments and other payments. We're talking about payments on debt, such as your mortgage, your vehicles, possibly credit card payments, anything you're paying on debts. Maybe you got, maybe you owe some back taxes you got to pay on. Now this is all the business's expenses or the business's payments, not your personal. Those have been included in your personal expenses, which we did in the last lesson. So we're talking about back tax payments, and also we may even be thinking about other payments or other monies you need to set aside or desire to set aside to purchase additional equipment, possibly a sinking fund to replace equipment, or maybe like every few months you're going to have to replace some equipment or do some heavy some amount of maintenance or repairs on a piece of equipment. So if you know it's going to be like $500 every 5 months, of course you want to set aside that $100 a month so you're not hitting by surprise 5 months away. So you would include that in the payments here. So, all right, that's part of debt and other payments. So let's look at Jim's. Let's look at Jim's debt payments. He doesn't have a whole lot. He bought that lawnmower. Okay, he's got $220 payment on his super duper wide deck lawnmower that goes really fast, we hope. And he also has a $300 payment he wants to make on a $3,000 credit card purchase or purchases that he had to make to buy all the rest of the equipment he needed in order to go into his lawn care business. So that's more than the minimum payment. He'd like to have that thing paid off in less than a year. So he's attempting to make a $300 payment. So he's still counting it. So his total is $520 per month on his debt payments. So as you can see, we add that to the formula. So now we're working up the ladder still. He's got $4,308 in personal bills. His business needs to generate enough money to pay, and also the business needs to pay $520 in other debt payments. Now we're on to up the ladder to variable and fixed expenses. So let's explain these. We're really going to focus on fixed expenses and the rest of this lesson, but we're first going to introduce you to variable expenses, which we'll really dig into a lot more in lesson 4. They can be a little more complicated. So variable expenses in general, these are expenses that vary directly with the items that you're selling or the work completed. They're directly related to you producing your product or service. And these are usually measured by the job or by the customer or by the unit. And a good way to tell if something's a variable cost or not basically means if you're not providing your product or service, you're not going to have these expenses. If you're not producing anything, these are costs that go directly into your to your product or service. Say, for example, if you're making a birdhouse and you got to stay home one day for whatever reason and you're not sick, you're not going to incur those expenses for materials, screws, paint, wood, lumber, all that. You're not going to have them. They are not what we call fixed. They vary directly with the number of birdhouses or the number of meals you would serve or whatever. We'll discuss that in a little more detail when we discuss that in the next lesson. All right, but they are really important for retail, and manufacturers are going to have pretty high variable costs if you're building something. If you're building a house, for example, you're going to have a lot of expenses that will vary directly with the type and the style and the fact that you're building a house. Most service businesses, however, are going to have very little variable expenses. Most service businesses, you know, like if you're cutting hair, of course, you're going to have shampoo and chemicals and that sort of thing if you're a beautician. If you're in a professional service, say like financial planning or something like that, you're really not going to have a lot of variable expenses. So just keep that in mind, that if you're in manufacturing, if you're taking a resource and turning it into something else, those are going to be much more important. So let's go into fixed expenses. Variable expenses we'll catch in the next lesson with a lot more detail. Fixed expenses. These are costs that are not directly related to production. So that means basically you're going to pay these costs whether or not you're producing your product or service. So if it doesn't matter if you don't have any business that day, you're still going to be paying these expenses. If you don't go to work for a week but you still have a business, you're still going to be paying these expenses, and they're going to be relatively fixed from month to month, or you can easily calculate it in month-to-month terms, so we're always comparing apples to apples. These are going to recur on a regular basis. These are often measured, you can tell fixed expense because it's usually measured in a unit of time. It's not usually measured like a variable expense per unit of production. So these are going to be measured in increments of time, generally monthly. You might hear some folks call these might be what we call overhead. These are expenses you're going to have whether or not you're producing a product or service. These are fixed costs, okay? Fixed expenses are also called fixed costs. So let's give you some examples here. Some common examples are rent, insurance, electricity, your utilities in general, professional fees, advertising. You got certain budgeted items that aren't directly related to your product or service, such as advertising, indirect payroll. Now I say indirect payroll, that would possibly mean, honestly, most of your payroll is going to be overhead, unless somehow you can really tie that payroll into that product or service, even what they call direct payroll. If you're paying someone 40 hours a week, every week they're there, and you can't let them go if you're not producing that day, or let them stay home if they're not producing that day on a particular day, they're kind of a variable cost, but they're really, you know, for practical purposes, they're also overhead. But if you have a secretary or something like that who's there not producing anything, they're definitely indirect payroll. They are a fixed expense. So let's look at Jim's. Let's look at some of Jim's fixed expenses. He's got a storage unit, paying $140 a month for it. That's where he keeps his equipment. He kind of uses it as his quote-unquote office because he leaves home every day and he goes gets his equipment from the storage unit. Then on the way home, he puts everything in there. So that's kind of where he starts his day out, is his storage unit. He has liability insurance of $75 a month. He has a bookkeeper, believe it or not, which is a really good thing for small business owners to have because you're not spending a lot of time doing it yourself. You can invest your time in making current customers happy, getting new customers. That's what business is all about. So he has a bookkeeper, kind of keep you straight. This bookkeeper, by the way, if you learn from the customer experience, this one knows what he's doing, or she knows what she's doing. So $125 a month for a bookkeeper, which is a good deal, by the way. Supplies, office supplies, $25 a month on supplies and incidentals going for the office for billing and whatnot. Now he also has auto repair of $50 a month, and he also has auto fuel of $150 a month. And you'll notice I have asterisks beside those two, auto repair and auto fuel. And the reason I have those asterisks there is he may have these on a month-to-month basis repairing his vehicle because he knows that's how much wear and tear he puts on his vehicle, so he's budgeted for that. Same with the fuel. But remember, he's in a business of driving between jobs. He does a lot of driving. So I put the asterisk there just to let you know that even though these costs are relatively fixed, they can vary with the nature of how he decides he's going to run his business. If he is able to have his jobs a lot closer together, so he's not driving as many miles, of course his auto fuel expense and his auto repair expense are going to be less. So I just want to make you aware that that this is really not always as cut and dry as it seems, because anything he can control, given the nature of his business, is something that he could possibly have vary to an extent with the number of jobs he's producing. So I just wanted to point that out. His cell phone, $135 a month. He's got auto insurance on his business truck, $85 a month. Now what's interesting here is, like most of us, he doesn't pay his auto insurance on a month-to-month basis. He has a 6-month policy, and that's $510 every 6 months. So what you want to do and what he wants to do is he knows he's going to pay that in 6 months or every 6 months. So he wants to take out $510, divide it by 6, comes up with $85 a month, and he knows he needs to set that money aside every month as a fixed expense because he knows it's coming up. And that's very prudent. It's what I want you to do also. So we total all this up, and his fixed expenses are a whopping $785 each and every month for Jim's fixed expenses. So here we see now, there's Jim's fixed expenses of $785 a month. He now has his other payments, that's his debt and other payments of $520 a month. His personal bills includes his taxes of $4,308 a month. Now your job in doing this is we want you to determine your debt and other payments. So go through your books. Even if you're not in business yet, you're planning your startup, you should be having some kind of business budget. You should have some idea of what you're going to be spending money on. If you're going to finance anything, how much you're going to finance, what is your monthly payment estimated to be. If you're already in business, you know that, so you want to be calculating that information. Also, if you have any sinking funds, if you know there's certain things that are going to have to be taken care of at a certain time, like with the insurance or with repair, make sure you have annual payments maybe for insurance. I don't know the nature of your business, but you want to put everything that's fixed on a month-to-month basis so we can always be comparing apples to apples, as they say and as I say. Then we want you to determine your fixed expenses. You can go back to the video and watch to get some examples. These are items that are going to be relatively fixed from month to month. Just remember, you could tell a fixed expense because if you're not producing your product or service, you don't go to work that day because you're sick or for whatever reason, or you take the day off to go fishing, whatever you might do, you're still going to have these expenses. And that's really how you can tell what a fixed expense is. So thank you so much. And in the next lesson, lesson 4, we'll dig into the variable expenses, which we introduced in this lesson.